Everyone. In today's episode, I'll discuss when interest rates will come down. There's a couple of things I want to get into here. First of all, the definitions. Second of all, the history of interest rates. Third of all, what influence interest rates. And then finally, when interest rates will come down. Let's get into it. Look, what we're really talking about here is the definition of interest rates. Really, we're talking about is the cash rate. And that's the rate of interest which central banks charge overnight to commercial banks. So really, that's what the banks really borrow at. Yes, they charge a couple % more than us, but that's just the way it works. So it's what the rate of what banks borrow money at. It's as simple as that. Look, the history of the cash rate really is one that's kind of gone on a downward slope. So you can see here in the early 90s, it was above 17%. Then it went right down to kind of like 5 to 7% for about 10, 15 years. And then it consistently kind of went down from there. So that's just something to consider. Like interest rates are I wouldn't call them super low, but they're fairly low in the grand scheme of things. But like, mind you, they can't raise it too much more because the economy would just crumble and the whole society would crumble. So that's another thing. But look, interest rates are influenced by a few different things. There's both primary factors, and there's also secondary factors. Primary factors are ones that that very much have a large impact on what they consider. Secondary factors are things that still do have an impact, but not as much, and are not really the forefront of what they look at. Your key primary factors really in terms of influencing interest rates are inflation, definitely number one, your labor market, and GDP. So look, when the RBA generally meet, these are the three key things that majorly influence, I'd say influence to 70 to 80% of their actual decision for what they do with the cash rate. So that's your primary factors for the Australian Reserve Bank. I've kind of got two tiers of secondary factors. So your secondary factor first tier would be real wages, the international economy, consumer sentiment, retail sales, and business confidence. Those are things that are secondary factors, but your more important secondary factors. Your second tier of secondary factors are building approvals, commodities, stocks, so that's the prices of stocks, house prices, and current interest rates. So they all have a very minor effect, but they do still talk about them in the RBA because often these factors that are sort of your second tier, secondary factors do actually influence what's coming ahead in terms of inflation, GDP, and I guess the labor market even too. Look, let's get into the final point just of this video here, and it's when will interest rates come down? And it's an interesting topic because there's a couple of things I want to get into. So first things first, when we cut interest rates and by how much? Secondly, the NZ rate cuts. Thirdly, the US yield curve, that's a very interesting one. And then finally, when rates will come down. Look, let's start with just the interest rates and when we actually cut them by how much. So you'll notice here, this is just again off the RBA's actual website. You'll just see that where the interest rate cuts have come, the main cuts, you kind of got a large sort of consistency in rate cuts. So generally when they cut once, they generally cut a few times. There's pretty much been no time in history where they've only cut once. They always do multiple, pretty much. And when I say multiple, I mean over at least a 12-month period, right? They won't cut once and raise 3 times. It's just the way they do things. If they raise it a couple. If they cut a couple. It's as simple as that. So look, you'll see in the early 90s a massive fall in interest rates there. You'll see also after the GFC there and the COVID crisis too. You could argue there's a couple in 2010 to probably 2018 and also a couple in the sort of late 90s, early 2000s dot-com bubble as well. But look, you'll notice just there that when they cut interest rates, it's generally down and it's down quite a bit. It's usually at least 1%, usually. So that's really what we're kind of looking at here. So anyway, that's a little bit of data for you there in terms of when they actually cut. An interesting thing that's actually happened recently as well in terms of interest rates here is, look, interest rates in New Zealand. Now, New Zealand, it's interesting because New Zealand is generally slightly ahead of us, but recently in August, they actually already did their first interest rate cut, which is crazy. Like, and mind you, their inflation is actually still over 3%. It's only slightly, but it's still over 3%. But the reason being they had to do the cut is because the labour market and the GDP were getting absolutely smashed. So they had really no choice. They could not wait until, the actual, should I say, inflation fell below 3% because everything else was going so badly. So that's what actually happened in the New Zealand Reserve Bank recently, and they've got more rate cuts priced in as well. So look, it's something probably to consider of what's happened sort of elsewhere. New Zealand is the most similar market to Australia because they have I'd say, look, it's not exactly the same. They have similar lending to Australia. They have full recourse lending like us. Generally, the deposits are a little bit high and they don't have as many products as we do, but they definitely still have lending. So consider what's happened in New Zealand recently as well. Look, something that's recently happened as well is crazy, and that's like the United States yield curve. And this generally is a predictor of what's actually going to happen in the short term. It's generally fairly close to right, or it's not necessarily fairly close to right, but generally it does follow the yield curve quite consistently. So you'll see here just alone that you in this graph you have the sort of dotted orange line, you'll have the dotted green line, and then the hard actual blue line. So the dotted yellow or orange is kind of the 6 months ago. The dotted green is then a month ago, and then this is in August, mind you. The actual hard green line is the day I actually took a photo of this, or from the article. And the crazy thing is, it's got like in the next year, like more than 1% of rate cuts basically priced in here, which is insane. Like by the end of 2025, that's basically like over 1.5% kind of rate cuts priced in. So the crazy thing is like generally the US, right? Generally the US and Australia. Australia's generally 3 to 6 months behind the US and about 3 behind New Zealand. So what this kind of means is really if data follows data and consistency follows consistency, we're probably getting a rate cut. I mean, probably latest like earliest November, probably latest February in 2025. So November 24 to February 2025. So that's just something to consider just on pure timing alone in the world economy. Look, a New Zealand example of where interest rates come down again is you'll notice the inflation rate, and this is what I was talking about previously. It's obviously clearly fallen quite a bit, similar to Australia's. Ours might be a little bit more sticky, but it has fallen a little bit, similar to this. And again, they started cutting rates already at like literally above 3% yield. So just consider that as well. It's just insane, like what's kind of going on there. But look, when interest rates, Australian interest rates are going to reduce, and that will happen when a couple of things happen. Inflation reaches close to 3%, and we're not far off that now. I think we're at like in the mid threes or something like that at the moment from memory. And look, the other thing is the underlying economy stays weak or falls further. So that's going to happen. I think at best it's going to stabilize. At worst, it will get worse. And then finally, the international economy, particularly the US's rate cuts, priced in 3 to 6 months beforehand. So look, rate cuts are coming to the United States. They may have already happened by the time I release this video. But look, as I said, that is going to reduce interest rates 100%. And then this finally, this is going to lead to a couple of things. And the things I've got in here is a first rate cut from November 2024 to February 2025. As I said, with the timeline, if all stacks up, that is realistic. Then I think 3, possibly 4 rate cuts before the end of 2025. So that's something somewhere between 0.75 to 1%, I think, something like that. Then finally, a cash rate of 3.35 to 3.6% by the end of 2025. So if we just consider that, look, I think we're in quite a good position. If you're buying a property now, you're in very good hands, because when cash gets easier, or should I say borrowing gets easier, property prices always go up, and there's almost an immediate effect on sentiment. So I remember even in COVID, and the interesting thing was, I'd say between sort of mid-September to the end of October, you had literally at some open homes, 5 people at it in sort of September. Then by sort of mid to end of October, you go to the same kind of home in the same street, and you'd have 55 to 100 people at the property. And simply because the news told them that borrowing would be easy, and their mortgage brokers are hitting up and saying you can actually borrow and afford this home now. So it has a big effect. So you don't want to be the one that makes a mistake and gets in when this has already happened, because the floodgates open and you've really missed your opportunity to buy with no competition and getting better stock. So that's the key thing I'd say for everyone. Just consider that, and if you're serious about buying, buy now. And look, another thing as I want to just mention to everyone, Premier Properties is coming to my site, so just have a look on my website soon. So what Premier Properties is properties with a total return of above 13%. Most buyers agents, as I've said, generally get somewhere between 9.5% and 11% total return. So that's your immediate yield plus your long-term, so it's 30-year capital growth. To give everyone an idea, most buyers agents will do this. They'll say, I bought in Logan, I bought in COVID, where you could have thrown a dartboard at the Australian map and made 25 to 30% minimum, and they'll use that as their growth rate. But the truth is, yeah, it might have done well over 1 or 2 years, but over the long term, it's going to go back to its 3 to 5% long-term average. And yeah, you might get 5 to 6%, but that's a total of return of around 10%, or even maybe less. So they're just rubbish. So look, if you're genuinely serious about buying property, I'd recommend either reaching out or just keeping a quick eye on my site, just to see when Premier Properties becomes available, or if it is available now, and click on it and sign up, and you'll have access to all these properties. It'll be strictly for Compound Invest people that actually sign up. And not only that too, but you might even know someone, you might have a friend, you might have a family member or someone that you come across that is looking, and they just are struggling to find a property. I would recommend this especially for investors and also owner-occupiers who want a good lifestyle in an area that's actually going to benefit them long term. So just stick around for that. And please, everyone who's watched this video and has found it useful, subscribe to my channel, and please ask for anything that you'd like me to make a future video on, because I will. And anyway, look, I really appreciate everyone's support, and thanks again for watching. Have a great day, everyone.